Okay, good morning, everyone. How are you doing today? Welcome to the weekly webinar for stock options. My name is Greg Kilpack, and I've been involved with the markets for over 30 years. And we focus mainly on vertical spreads here, which is debit and credit spreads. Okay, so welcome to the show. Hope you pay close attention. Got some good information for you this week. Let's look at what's going on in the marketplace. First off, let's take a quick look at Evergrande, see what's going on there. Yeah, Evergrande is still having problems, and the news is only going to get worse out of China on Evergrande. Here's some of the headlines. China Evergrande shares hit a new low amid the debt crisis. I read one a while back that said something about they're unable to even perform their business function. So at least right now, they're going to go out of business if they can't even operate as a going concern. Um, Here's an article on Fortune. Two Chinese real estate giants face default. Uh, you know, Evergrande is not the only company that's having problems in the real estate sector. When you do debt like this, like China is doing and the United States, it's kind of like a kid who gets a credit card for the first time. He's got a $10,000 credit limit. And what does he do? It's a lot of fun. He's living large. He goes out and spends 10 grand. But then on the other end of it, when you actually have to pay for it, it can get painful. And that's exactly what's happening right now in China with Evergrande and their other real estate development companies. So all this great growth that you're hearing about in China, it's some of it's real production, but a lot of it is just debt, and it's going to blow up big in their face pretty soon. It's not just the real estate sector, okay? It's their whole economy. All right. Let's see. China Evergrande investors relax despite default deadline. Yeah, sure they do. Evergrande crisis, not a Lehman moment. Yeah, we'll see. So anyway, whatever. This is some of the news coming out of China from Evergrande. Now, last week we talked about Gary Kaltbaum, the radio announcer who also invests and manages money for investors. He's got a radio show called Investor's Edge. I listen to him all the time because he comes up with great market information that I may not be aware to check. And I'm going to share some of that with you today. Okay, here's an interesting statistic for the market just this past Friday, which was a pretty good. Let's see. Let's look at how the market was on Friday. Okay, we had a nice up day, gap up on Friday. Very nice. So on Friday, in spite of the market going up pretty strongly, we had on the New York Stock Exchange and the NASDAQ, we only had 50 new highs and 943 new lows. Wow, that is not a good statistic. That tells you, just how weak the market is. Okay, that's an interesting statistic. What's going on there? Okay, that's new highs and new lows. Let's look at this one. This is also for the same day, Friday, which was a strong day. The New York Stock Exchange had 1,132 stocks that went up on the day and 2,996 stocks that went down on the day. 2.5 to 3 times as many down stocks as up stocks, while the whole market indices are showing it's up strong for the day. What's going on here? Same with the NASDAQ. 959 stocks went up, 3,405 stocks went down. That's another curious statistic. Same thing happened a few weeks ago, November 19th. The NASDAQ 100, the biggest 100 stocks in the NASDAQ, went on to new 52-week highs for that index. The same day, 500 stocks had new 52-week lows. This has not happened before. This is unprecedented. What's going on? Okay, why are we getting such weird divergences here? Well, that's part of what happens when you get bubbles in the marketplace and when it approaches the high or has passed the high, which might be the case with us right now. Okay. Gary on his show, Gary Kaltbaum, said that this is what happens during when the market is topped out, when a bear market is happening. Gary says that we're in a bear market right now, that most stocks are at least 20% below the highs. That qualifies as being bear market territory. And some stocks are much further than 20% below the highs. You know, some of the SPACs and some of the Chinese companies have been absolutely slaughtered and are down over 50%. Definitely qualifies as a bear market. So how come the indices, or the indexes, depending on how you want to say it, why are they only off maybe 5, 6, 7% from the highs? So what that does, what I think this is, and what I've noticed in the Dow stocks, and what Gary said on his show is something I'm starting to notice, is this is a controlled retreat. What that means is they're masking how badly the market is getting a hit right now. So, the average investor will come home, look at the most popular index in the world, the Dow Jones Industrial Average, and say, oh, hey, the Dow is up on the day, or the Dow is down. And then Gary was talking about how they buy it up in the last 10 to 20 minutes of trading or something like that. So the big down days that have happened over the last week and a half, they're down pretty heavily, but they just bounce it up at the very end to make it look not as bad as it actually is. Okay, so if you look at these different market breadth indicators, these numbers that I just showed you, they reflect what's really going on in the market right now. Okay, this is a controlled retreat. And Gary was talking about how what it really does is just kind of hide the truth from the public. And I don't like that. I don't appreciate that, because I think that's deceitful for one thing, and it's not showing the truth of what's really happening in the market. So all they're really doing is trying to make themselves look better. Okay, just like they're trying to say that all the money they're pouring into the economy will not cause inflation. Then they try to say it's temporary. Well, guess what? It's not. They're liars. Politicians are born liars. So this is what's really happening in the market. As a consequence, any of the stocks, I'm going to steer a little bit away maybe from the Dow stocks that are being manipulated by the government to do this, to reflect, a better than what's really happening. And I'm going to veer away from that. And I'm going to be definitely looking for positions to go short. All right. My partner, Steven, he is a more bullish kind of guy than I am. I'm more bearish. So you have to take both what we say with a grain of salt and make your own decisions. But these statistics, they speak for themselves. Okay, now let's look at some stocks. This is the diamonds. You can trade this. It trades exactly like the Dow Jones Industrial Average. Down just a little on the day after a very nice bounce over the last, end of last week and yesterday. Okay, so this is what's going on in the market. That's the backdrop. And this is what's happened with a trade I just sent out an alert on, and I just entered for myself. This is Box. They do content management systems, software. When I sent out this alert, let's see, just a little while ago, today's candle, in fact, it still is. Look at this. It's up on the day, barely, just 2 cents. But the candle is red for today. Why is that? That red candle, all that really represents is that the stock is trading currently lower than where it opened. Whereas the price up here just tells where it represents compared to yesterday's close. Right now, it's at exactly break even. This thing's selling off. So I just bought puts on this and sent out an alert. Now, here's something I need to show you on Yahoo Finance because it doesn't show it very well anywhere else that I've seen. This is the 5-day chart, intraday. This shows you what's going on within the day. And as you can see, what they did and what they're doing a lot lately is they pop it up at the open and sell it off the rest of the day. So they did that this morning. Let's see, where's the exact opening trade here? Right there. They popped it up in the first 10 minutes of trading, and they've sold it off since then. It looks like they're going to sell it off more. Okay, this is a 5-minute intraday chart. So this is what's happened since the open right there. Okay, that looks really bearish to me. Let me show you something else on this chart. Here's the 6-month chart, and I showed this on the alert that I did. This is sitting right at resistance, a major resistance level at 27. Hold on a second. There we go. Okay, so we bounced off resistance there at 27 once back in July, again about a month ago, early November, and it's come close to that and gone dead in its water, dead in the water. Okay, whoops. This gapped up about a week ago, right into that resistance level, right below it slightly, and it's not rallied up while the rest of the market has been rallying. Okay, that is definitely a bearish sign. Hit against the ceiling of resistance and just hit it hard. This is not going up from what I can tell. Furthermore, every time intraday, you see these tails on the top, also called shadows, the little tails above the body of the candle. Every time it goes up above 26, intraday, they sell it back down. For that reason, I bought puts. You could have also sold calls at 27 and then bought a higher call to do a credit spread. I just went ahead and bought puts, and I bought the 27 puts so that they would be in the money. And what did I buy? I bought 22 puts. So I don't think it's going to go much below 21 or 22, something like that. I think this is just going to sell off. It might just go sideways for a while. I don't think it's going to go up. Maybe a credit spread would have been better on this trade. I don't know. But I bought puts. That's what I want to do. I think it's going to go down to at least 23.50 within the next month. I bought the January 21st puts, I believe. Okay, so this one looks like, a good candidate showing relative weakness compared to the market. It's a reasonable bet. It might not work out. We'll see. Okay. Let me take a moment now to look at the comments. I noticed the COT report is showing commercials are selling S&P 500 futures and accumulating bonds. Okay, that doesn't surprise me at all. The futures market leads the stock market. 20 years ago, when I was a day trader, we were looking at the trend of the futures market because the stock market will always follow major moves in the futures market. The reasoning behind that is that if a fund manager owns a big portfolio and he's got it in the right percentages that he wants for his portfolio, if he thinks short term the market is going to go down, he'll keep his portfolio the way it is because it's in the right percentages that he wants. But then he will just buy some puts on the market to kind of hedge his bets. They use the markets as a hedge, the futures market. Okay, so doesn't surprise me at all. They're hedging their bets right now with the market falling the way it is. Actually, not the indices, but the rest of the stocks. Okay, and Jeremy also said, let me see here. When the market makers drive the price up and then down, are these traders buying and then at the certain price level selling their shares and then shorting? Could be, could very well be. The biggest trick that I've noticed The easiest legal way for makers and professionals, the specialists, to manipulate the market is at the open. So when you see a stock that's in a downtrend or a market that's in a downtrend, what they do is they gap it up and sell it off. They did it actually on gap day, the very first day. Let's go back to that and take a look. This is the gap day right there. So it gapped up on some news. I don't know what that news was. It gapped it up to about 26.17 or so. It rallied for about 50 cents and then through the morning, and then they sold it off the rest of the day. And where's the end of the day? Right here. So it ended up at 25.81 and the high was at 26.81, and the open on that first candle was 26.43. And where did it close? 25.83. So it closed $1 lower than when it opened. Okay, that's very telling. That shows a lot about what the professionals are doing. They tend to, in a down market, or if they want to sell it off at least for that day, they'll gap it up and sell it off. Why do they do that? They're giving themselves better prices, higher prices to sell at. They do the opposite on the downside. When the market or the stock is going up, what do? They gap it down and then buy it all day. Sometimes they'll buy it all day. The stock price will be higher than where it opened at, but it still looks like a red candle because it's lower than the previous day. That's actually a sign of buying, not selling. It's very deceptive if you don't know how to look for that. But I see that all the time, in the markets, and especially lately. Okay. They do it both ways, Jeremy. They gap it up and they gap it down, but they gap it down if they want to buy it all day, or gap it up if they want to sell it off all day. Now, keep in mind, they don't, okay, I'll tell you, I'll explain a gap in just a second. But they do this so that, they can make more money on their trading. I'll explain that in just a minute, what a gap is. But basically, sometimes, stocks that have some horrendous news, they'll gap down and then trend down, just like on our Disney trade. But on just a daily basis, they're giving themselves better prices to gap it down and buy it up. So you kind of have to watch after a gap to see which direction it trends after that. Okay, let me explain what a gap is. Pretty easy to see on this chart. Back on November 30th, Box was trading down here at 23.41, and then the next day it shot up and opened up way up here. Most days a stock will open pretty close to where it closed the previous day, but what you see is a big space on the chart between this day and the next day. They call that a gap, where it opens a lot higher or a lot lower so that the candles aren't right next together. That's called a gap. That means a big change in price from one day to the next. It's almost always based on some news. Okay. And so I haven't looked to see what the news is on this, but I can tell with Box that it's not trending up from here. Unless something changes, it's going to trend sideways or down. While the market is trending up, Box is not. So it's showing a lot of relative weakness here. The sellers are selling pretty heavily at this resistance level. Okay, so I may not lose a lot of money by doing a trade on this, but I could gain, a good return on this if it goes all the way back down to 23 or lower, something like that. Okay, so that's a good low risk, high potential profit trade. Very nice. That's how we want to set up our trades. YouTube user, do you understand now what a gap is? Let me know. Make sure I explain that really well for you. Just a big gap on from one trading day to the next, like is shown right here. Now, if you see a little gap, usually doesn't mean something, but when you see a big gap like this on high volume, that's worth paying attention to and finding out what the news is on that. Still not clear what is actually happening. Okay. What it means is after the close on November 30th, they announced some news, very likely. Some news came out. Sometimes it's earnings, sometimes it's something else. And the news makes all the investors think that Box is now worth more than it closed at that day. So it opened up around 26 when it had been trading around 23.41 where it closed. Okay, so suddenly this news makes the stock go up. But because it went up to a previous major resistance level, close approaching 27, the investors, professional money, think it's not worth more than that. So they're just holding it right here. And what isn't going to go up might come down, basically. Might go sideways for a while, like it has, but it also might go down. Market makers, professional investors are willing to pay more on this, okay? Over 90% of the money in the stock market is controlled by professional investors, hedge fund managers, mutual fund managers, pension funds, the big money. You know, when Apple trades, 50 million shares a day, and I buy 100 shares or something, or 200 shares, that doesn't move Apple's stock price. But when a hedge fund comes in and buys, 10 million or 50 million dollars worth of stock, that's going to move the stock price. Okay. And so it's the professionals who are moving the charts. It's the professionals who are moving the prices around on these stock charts, almost all of them that you look at, except for maybe penny stocks or something. Okay, so that means we're like dancing with elephants. We're trying to follow which way the elephants are going without getting stomped on. That's what I call it, dancing with elephants. Okay, and so this is what the big money is doing. There's an old saying on Wall Street for the amateurs. I don't have 100 stock analysts working for me. That's the bad news. The good news is I don't have to. I just have to look at the stock charts and see where they're putting their money to determine what they're thinking. Okay. So for that reason, I recently bought the puts on a Box. Okay. If it doesn't start to go down within, a week or two, then I'll exit the position, I suppose. But that's what's going on right now with this particular stock. Let's look at a couple other stocks. Verizon. My gosh, look at this thing. It is such a steady, decliner. Excuse me. So we should have noticed that every time it even pops up close to the middle of the Bollinger Bands here, that it is going to sell off. And so maybe next time, if I'm paying attention, if it goes back up to the middle of the Bollinger Bands around 51.40, I'll probably take a short position or buy a put on this or sell a call, because this thing has been so steady dropping. My gosh, look at that. Why didn't I put a trade on this 6 months ago? I don't know. Didn't see it, didn't pay attention. Okay, but that was, a nice steady downtrend on that. Let's look at Visa. By the way, if you have any stocks you want me to take a look at, now's the time to start putting them in so I can take a look at this. Visa has popped up at another steady downtrend. Okay. I'd like to see a little bit more evidence that it's going to reverse. I don't see it yet, but today might be the beginning of that. I don't want to enter the position just yet. I want to be convinced that the stock is headed back down to the previous lows around 190 before I enter the trade. But if you look at previous examples, stock goes down, retraces maybe a third to a half of the down move, and then resumes the downtrend. Looks like it's done that. And it's losing steam pretty fast going back up. So might be about right to sell a call or buy a put, do a credit or a debit spread on this. What would a credit spread be on Box? All right, let's go back to Box. Okay, so for Box, we see it's been, pretty much going sideways at this price level around 26.15. It'd be real easy to sell a call at 27, saying it hasn't gone up to 27 in about a month, hasn't gone over it in more than, let's see, it has not gone over 27 in at least 3 months. So that's a pretty safe bet that it's not going to go up past this level. So you might, sell a 27 call and buy for protection a 28 call, something like that. Maybe a 29 call. If you want to hold it close to the vest, I don't like to do this because if, let's say, I don't even know if they offer this, but if they offer a 26.50 call, you could sell that. You'd make more money if they offer it, but you're risking a lot more. You can't, it's already at your stop loss point, so you can't enter and then get stopped out immediately, right? Furthermore, you could get exercised if you do that. So that's not the best choice for most new traders. I'd want to sell the 27 call and then probably buy a 28 or a 29 or a 30 call for protection, depending on how much money you would get for that trade. Okay. So that's kind of what I'm looking at. When you decide, you're trying to determine which is better, a credit spread or a debit spread, you really don't know. If this thing goes sideways for the next month at the current price, a credit spread would have been the right choice. But if this thing trends all the way down to 22, which I have no idea for sure that it's going to do that, well, then a debit spread would have been the right choice. If it goes sideways, you would make money on a credit spread, but not a debit spread. You'd lose money on a debit spread. Okay, that's the difference. Credit spreads are a little more conservative, but we've had so much volatility in the markets lately that I think long term we're going to make more money doing debit spreads. So I've kind of switched a little bit based on the market environment to focusing more on debit spreads. I'm sure those of you who have paid for the alerts have noticed that. Okay, that's what's going on. It may not be the right choice for this particular trade. Who knows? But that's what I'm betting on for the immediate future for most of my trades. Okay, let's look at TMUS. That's an ugly looking chart. Let me hold on for a second, see what's going on. Oh, this is T-Mobile. Oh, okay, I know that stock. Let's go back. Computer's running a little slow. Okay, so T-Mobile has already taken a big hit. It's topped out around 149 or so, 150 back in July. Definitely in a downtrend since then. Perfect example right there. T-Mobile, in a long-term downtrend, it gapped up on some good news, and within a few days, they started selling it off again. That would have been a beautiful entry point. Didn't see it. I don't see every trade that comes up on the 12,000 plus trades that are available in the market. So this is one of those I didn't see. Let's look at it now. Okay, we had a strong few days. It's looking like it might be reversal time on this. Maybe if it goes below the low of this day, tomorrow, or today, I probably would want to do a short trade, a short position of some kind. It could be selling short the stock, it could be buying a put, or it could be selling a call above around 118 or higher, depending on where you think the stock is going to go. Like I said, I'm in the put buying mode at the current moment. T-Mobile was hacked. Bad news for them. Do you look at the P&L graph before trading spreads? I don't look at the graph, but I definitely calculate the P&L before I enter my trades. Definitely. You want to know how much you're risking. You can't determine risk if you don't, determine the potential profit versus potential loss. So absolutely, I don't have to put that in graph format, but I definitely calculate that. That's a critical calculation whenever you're doing a trade. Let's say I wanted to do a regular short trade on T-Mobile right now. Okay, where would it prove to me on this chart that I'm wrong? If it starts to not just go intraday above this price of 117.15, but if it trends above it. So I would sell it at 115.20 current price, and I would maybe put a stop at 118.20. That's a $3 stop. Okay, so if I only want to risk $300, I can only sell short 100 shares. Okay, if I want to risk $600, I could do 200 shares short. Okay, so the risk is $3 per share. What's the potential profit? Well, from 115.20, the potential profit goal target would at least be this, 106.72. Let's call it 107. So that would be what from current prices? 107 be $8 a share. All right, so is it a good idea to risk $3 a share to make at least $8 a share? Well, that's more than 2-to-1 profit versus loss on a stock that's in a downtrend. I'd say that's a pretty good profit profile versus risk. It's potential 8 profit versus 3 loss on a stock that's in a major downtrend. Yeah, those are pretty good odds. I'd go with that. This looks like a pretty good trade potential here. You got to go with a long-term downtrend that's below the 50-day moving average, purple line there. Goes right up to the purple, just like it did here. Came back down. Looks like it might do it again. All right. Now, if you're really gutsy and you're watching, you see it come close to the 50-day right there. And at the open today, as it starts to go down, that's where you enter. If you really want to play it tight, you might say. Okay, can we look at Sophie or B of A? Oh, the spread on it. Okay. SOFI, Sophie Technologies. Oh, wow, this thing is wild. Pretty volatile. Now, your best odds of success are going to be if you trade at support and resistance levels. So looking at about a 3 to 6 month, this is about a 6-month chart. Major support is right there at 14. Major resistance, which is hit a couple times, is up here around 24. We're kind of in the middle on this. If I had to bet on this, I'd probably bet on the upside because it's likely going to trend up. Well, it's below the 50-day. But here's the thing. It looks like it's bounced off the support level down here around 15. Risk maybe a couple bucks a share to potentially make, where is it at? 17 up to 24, which is $7 a share. So first off, do you think it's going to go up all the way to resistance? That's a critical question. If the answer is yes, the second question is, are you willing to risk about $2.50 a share to make, what did I say, $7? That's about 3-to-1. That's pretty good. Based on that, I'd say this looks like a good long trade. The really long-term trend on this is sideways, with the mid-level being right about there, around 18. So if you think it's going to go all the way up top to the top, then it's worth doing this trade. Personally, I'd like to have entered it yesterday. Okay, towards the opens for a little bit better price. But yeah, this looks decent long. I like to look at the major volume over the last several months. You look at only the big volume candles. There and there, it's a big red candle showing bearish down. Going back into the bullish cycle, it's green, several biggest green candles. So I don't know. This is a pretty good potential up trade. Look, let's see. Do you trade calendar spreads? No, I don't. I stay away from calendar spreads. Right now, I'm keeping it very simple. Just vertical spreads, credit spreads and debit spreads. The expiration is the same, but the strike prices are different. Let me see if I can find the strike prices on this. Let's see here. Okay, so it's currently trading around 17. Let's say we wanted to do this trade. On options. So let's see how this goes. Okay, this is going out to January 14th, over a month away. If I can get a quote from the, going to get a quote out of Thinkorswim? Maybe not. It's not worth. Well, I guess I can't show it to you. But basically, if I wanted to buy a call on this trade, I would want to buy an at the money call or slightly in the money call. So maybe a 17 call. I don't know how much I would buy for that. You could buy it outright, or you could then sell a call that up around 23. Make your trade a little bit cheaper. That's the purpose of doing that. That's a debit spread. You buy an at the money call, and then you sell where you think it's not going to go above that. If it actually, shoots to 50 tomorrow, you'd be giving up your profits above whatever strike of the call you sold. Okay, but it's probably not going to do that. So I'd probably sell a 23 call on this, and I'd reap the profit up to 23 and make my entry into this trade cheaper by doing that. That's a debit spread. We're going to do a credit spread. We think it's going to go up. We would sell maybe a 14.50 or a 14 put, and then a lower put, a 13 or a 12 put for protection, if the money is worth the risk. Okay, I hope I didn't go too fast for you on that. You might need to review this video to go over that if you didn't catch that. And yeah, that was the January 14. It's even better to go longer if you're buying options, because you're losing time value fast in the last 4 to 6 weeks. So really, I should be going out, to February. Okay, I'm not getting quotes right now on this through Thinkers. I'm not sure why that is. Let me see if I can do see if we can get some quotes on this. Let's go to February. Even March. Yay, finally. Okay, thank you. Is that Sophie? Yes, it is. Okay, so Sophie is currently trading at 17. So let's say we want to do a credit spread on this. I want to sell a 15 put. What would we get if we sold a 15 put? We'd get about $190. And then for protection, if we sold a 10 put, we'd get about $45. So we're basically would be buying this for, or rather doing this for about $150 credit. As long as it stays above 15, we'd make all the money on that. Okay. If I was going to do this again, I'm focusing more on debit spread. So let's do a debit spread on this. The calls are on the left side. So I would probably buy an in the money call around, let's see here. You could do a 15 call that's already in the money, pay about $400 for it. And then we would sell a, let's see here. We think it would go up to at least 22.50, maybe 25. I think for this, I would sell the 22.50. No, I'd sell the 25 call. I want to give myself the max profit. So I'm turning my $400 cost to enter at 15 down to $300. So I get $100 for that to sell that option. That looks like a great trade right there, actually. So I'd do this for $300. If the stock doesn't start to go up from here, or it goes sideways for a week or two, or it goes down, I'm going to exit the trade with a small loss, up to 50% generally. Okay, so that's what I'm doing here. Because I'm going both ways. Okay, I'm probably going a little bit too fast. Yes, February for a debit spread. Okay, so let me say it real slow for the debit spread. Because I think that this stock is going to go up and hit somewhere around here at the resistance level, I am going to do this trade. And if I'm wrong and it goes down to here, I'm out because it's proving me wrong. Now this is March. You can also do February if you want. This gives you a little bit more time for the trade to work, and you lose less time value by doing this trade. I'm going to do what's it at? It's at 16. I'm going to do a call. I'm going to buy the 15 call. It's going to cost me about $400. I want the stock to go up above 15. It's already above 15. Want it to go further up to the highs. It cost me $400. Then, because I don't think it's going to go above or much above 22.50, I could sell the 22.50 call for $142, 140 more or less, plus or minus a couple bucks. Okay, so that just brought my cost of 400 down to 260 or so, if my math is correct. Yeah, okay. $260 to enter this trade. If this trade doesn't continue to trend up from here, I'm going to exit. I'm going to get a small loss. I'm going to give it about no more than 2 weeks, maybe as little as 1 week. I'm going to give this at least 1 week to continue to trend up. If it starts to trend down here and go back down to the previous support level, in fact, if it goes goes down to about 15, I'm out. I'm going to lose about half the profit, half the cost of this trade. I'm going to exit, get about $200 back. No, excuse me. We entered for 260. We'll get it maybe $100 to $150 back. Okay. So we would do that. Okay, I hope that was clear for you. If that wasn't in any way, you can email me options@thetradersplan.com. All right, let's move on now. Let's go to BB. Blackberry. Okay, what is going on with Blackberry? Main direction is sideways on this thing between kind of a support and resistance level. I don't really like taking longs in the market too much right now because the overall market long-term trend is down. So I would much prefer to see any stock go up to resistance and then short it. Okay, you're more likely to have a profitable trade if you just wait patiently. Having said that, it could very well go back up to resistance around 1150 or 12. Okay. So February or March, I'd recommend March. Give you a little bit more time on the trade, and the time value loss will be slower for you on that trade. Okay. So that's all I have for today. If you have any other trades you want to, any other stocks you want me to look at, last chance. Now's the time. Let me look at something else real quick. See what else is going on. Semiconductors, one of the strongest industries in the market right now. It's holding its value, but it's not going up. If the market continues to trend up from here, we see a breakout on this, this would be a good stock to buy, but it's not doing that yet. Okay, very strong sector though. Boeing, let's look at Boeing. Okay, Boeing is like halfway between support and resistance. Resistance is the furthest level where the stock went down to. Excuse me, support is down here. Resistance is up here. So Boeing's like halfway between the two. What that means is your risk versus reward is about 50-50. I only want to do trades where the reward is much bigger than the risk. So I really don't like this entry point either way on Boeing. Okay, I don't want to enter right here for anything, stocks or options. Let's look at Sky. Skyline, strong uptrend, very bullish. The hard part about a stock like this is that it looks extended. You see how far it is from the 50-day moving average? It's really far, and it's above the Bollinger Bands. That's one of the things. Stocks tend to stall if they go above the Bollinger Bands for very long. So the right time to enter the trade would have been right there. A gap up on heavy volume for a stock that's in a long-term uptrend. That, of course, it's easy to look back and say what you should have done, right? If you weren't sure right there, that would be a beautiful entry point. I probably would have bought on one of those 2 days. Okay. For me, for my taste, I've jumped in too many times on a trade like this where it snapped back right after I got into it. So I wouldn't enter it here personally. But having said that, it could run up for quite a while. I don't know. It's not my favorite entry point though. Let's look at Apple. Same thing with Apple, a real strong uptrend, but it's going to pull back again hard at some point. It's too far extended. I'm not going to enter it right here. Missed the entry point. A good entry point is when a stock starts to go up on increased volume, like right here. One of these 2 days would have been good because volume is higher than normal, and it's going to new highs over the last 2 or 3 months. So that makes it a good potential entry point. Now, notice what happened. It went up high above the Bollinger Band, snapped back, but then the uptrend continued. Okay, so the best entry point would have been one of these 2 days right there. Of course, I'm, perfect. Hindsight is 100%, right? So might not have been quite so obvious, but that's what I'm looking for breakouts. I want to see increased volume showing the professionals are loading up on the stock. And that's what they're doing here. Is semi trending up? Is semi the ticker symbol? Hold on. Oh, the semis, you mean the semiconductors? Are the semis trending up? Yeah, they sure are. Semiconductor, well, it's right at resistance. It might trend up from here or not. I want to see it go above 72 and trend up above it, close above it before I want to enter. Try to be real conservative and safe with you guys, only get you in the very best trades. Okay, so if I had to bet on this, I'd bet on the upside, I think. Go with the trend. Bonds. 20-year bonds. Okay, again, over the last 2 or 3 months, you got these are in an uptrend. You just look at this right about here. But we're halfway through a pullback. If this was to go right down to this level right here, previous support level, and then start to go back up, that's your entry point. Right now, it's halfway between support and resistance. It's halfway between here and down here. What that means is your risk versus reward is about the same. I only want to do trades if the reward is at least 2 or 3 times what I'm risking. That way I can be right only half the time, and I'm still going to make money. Okay. This is a good example of how novice traders, their reward versus their risk is about the same, and then they're only right about the half the time, which means they're churning. They're treading water. They're not making money. They're not really losing money. They're losing maybe a little bit. So this is not the best entry point for this trade. It's halfway between support and resistance. Close above 72. How do you see that? Well, on a trade, if the resistance is at 72, I want evidence that it's trending and going to continue going above 72. I want to see it going above resistance, preferably on volume, showing me it's going to continue and follow through. Okay, that's what I'm looking for. Look at Kroger. I've been looking at Kroger lately. Interesting. Okay. What's the long term on Kroger? Definitely up. The long term on Kroger is up. It's down pretty big today. Look at that. This is one of my favorite entry signals. I wish I had seen this a little earlier. You see this right here? Look at that. 4 out of 5 days in a row. The top on these candles are almost exactly the same price. What is that? On this day, it was the high. If I can get that to stay, look in this corner here. The high on this day, if it would stay up there, is 45.12, 45.68. On this day, it was 45.58. On this day, it was 45.65. On this day, it was 45.58. Within a dime, it tops out intraday and they start pushing it back down. What is that a signal of? That shows you that some hedge fund manager or somebody told their trader, every time it goes up to this price, 45, 60, or 70, sell as much as you can. And that pushes it back down intraday. This is one of my favorite indicators when I see it, that a stock is going to go down. If it goes more than 25 cents above this price of the high, I'm out. It gives you a really tight entry point versus an exit point. So in other words, if it trends up 25 cents, I'm out about 25 to 40 cents, depending on my entry. But it could trend all the way down. And if I had done this trade, I'd be up about $1.50 right now, risking 40 cents. And it could trend down from here. So when you see these 3 or 4 tails on top within a few days, that's a really good signal, at least for the short term. It's going to go down. And we see that today. We'll see if it trends down from here. over the last, month, we had been trending up. Just from this period on, we had been trending up. Does this mean that this is just a pullback and it'll trend up from here? Or does this mean that it's going to trend down from here? I don't know. But in the short term, it's a down bearish indicator to see those little tails on top at exactly the same price, at least 3 of them. We saw 4 here out of 1, 2, 3, 4, 5 days. Wow. Every one of them except for that day. It's a pretty good indicator. It's one of those little tricky things I've learned along the way about technical analysis. So how do you determine the probability of a 3 times loss? I'm guessing you're saying on this stock here. So I'm going to risk about 40 cents. If it goes up above it to about here, I'm out. Somewhere up here. But if I entered right about here, I'm risking 40, 50 cents to make potentially $5. That's 10 to 1 reward versus risk. I like it. If I was in this trade and I was short, I would be holding on to it, hoping it goes down. And I would pull my break even, my stop to break even. Okay, that's how I would do that. Okay. I think that'll just about do it for today. Thank you very much for your participation today. We're going to keep a close eye on that box trade. If you have any questions, let me see. Can you clarify how you know it's 0.4 cents? That's a judgment call on this trade. What I'm doing is it had stopped out really close to the top. Not stopped out. It had made a high really close to the top at about 45.65 per share. Within a dime, 4 days in a row, it topped out at the same price. So I'm going to give it, maybe a quarter. Higher than that. If it goes that, I'm out. I don't expect that. So if yesterday I had done that, maybe I had entered at, say, 45.10, entered a short position at 45.10. I'm going to give it to, say, what did I say? About 45.80. So that's a little bit more than I thought. That's 75 cents risk to make $5 a share. That's more than 5 to 1 reward versus risk. So that's a good stop point based on this chart. And it's a good profit versus what I'm risking if I'm right. So if I did the same trade, say 10 times, and I'm only right half the time, I'm going to make, 3 or 4 times what I risked. Long term, this is a profitable trade. That's how you set up your trades to make money. Would I buy a put? Sure. Yeah, I'd buy a put on this yesterday, not now, probably. I'd buy a put, or this would be a great credit spread to sell a call up at 46. If it even comes close to 46, hits 46, I'm out. Sell a 46 call, buy a 47 or 48 call for protection. Probably a 48, I would think. So that's how I'm setting up my trades. You set up your trades based on support and resistance, and then you set it up so your risk is small and your potential profit is great. So that if you're only right 40 to 50% of the time, you're still going to make money. That's what we're doing on these. Okay. All right. Once again, if you have any questions, don't hesitate to send me an email, options@thetradersplan.com. That'll be all for today. And for those of you who bought the accelerator options plan that we offered about a month ago, I am doing the workshop for that tomorrow. So look for that, okay? If you have any questions, shoot me an email. It's been a pleasure to be here for you. I hope you learned something new and have a great day, okay? Good luck in your trading, all right? Have a great week. See you later. You're welcome.